Good morning, students. How are you all? Let us begin with a new chapter, Financial Management. Myself, KISHOR Chauhan, MCom B.Ed. Let us begin this chapter and the different aspects covered in this chapter. First, meaning of finance. We all know finance refers to money, cash, or fund available to carry out business operations. It is the lifeblood of business. A business enterprise requires funds at different stages. Say, for example, to start a business, to operate, and to expand it. Business requires finance for purchasing fixed assets, for making payment of day-to-day expenses, and at different stages, it requires finance. So simply, finance is nothing but it refers to money, cash, or fund available to carry out business operations. Now, what is the meaning of financial management? So it is management of finance. In simple words, we can say management of available fund in business is financial management. Now, when the word management comes, then it covers planning, organizing, directing, controlling, all the aspects of management. But they all are related with fund, business fund. So let us see the definition of financial management. Financial management is considered to be the management of finance function. It deals with planning, organizing, directing, and controlling different financial activities. Say, for example, procurement of fund and utilization of fund and distribution of earning to owners. So you can see here in this definition, three main aspects are covered. First one is procurement of fund. A business has to collect fund from various sources, ownership fund and borrowed fund. Thereafter, after collection of fund, this fund is utilized. That means it is invested in business in different assets. Thereafter, whatever earning is available, that earning is distributed to its owners. So there are the three main aspects: procurement, utilization, and distribution of earning to owners. Second definition is given by S.C. Kuchal. You can see financial management deals with procurement of funds and their effective utilization in the business. The word effective is used here because this fund belongs to outsiders. This fund belongs to the owners. So it should be properly utilized. So by this definition, you must have understood that in financial management, we have to manage, a finance manager has to manage available fund in business. Now, what are the objectives of financial management? You can see two objectives are mentioned here. One is profit maximization and second one is wealth maximization. These are the two main objectives of financial management. Now, what is profit maximization? The financial management should ensure maximum return on investment to the shareholder. Means whatever amount of fund is collected and invested in business, it must earn maximum return so that maximum return can be given to the owners of fund. Basically, in joint stock company, owners are the shareholders. They invest their money in company and they expect higher return. So it becomes one of the objective of financial manager to make effective utilization of available fund. So one of the objective of financial management is profit maximization. But it is not the ultimate objective because when we talk about profit, we are doing many wrong practices. Say, for example, giving poor quality of goods to customers, using poor quality of material and reducing the cost in order to maximize profit. But in long run, this objective cannot survive. Business cannot survive if it keeps in mind only the profit. Business has to also keep in mind other objectives. So profit maximization is not acceptable objective. No doubt, all business requires profit, but it should not be at the cost of customer satisfaction. It should not be at the cost of customers' exploitation. Second objective is wealth maximization. The ultimate objective of decision makers must be to increase the wealth of shareholders. That means investors. Every investor, every shareholder makes investment in business in the share capital, keeping in mind that after some time share prices will go up. Say for example, if today I have purchased 100 shares of any company at rupees 10, that means my investment is 1000 rupees. So I expect after few years this value go up. So increase in the market value of shares held by investor is considered as wealth increase. So how to find wealth of owners? Wealth of owners can be calculated by multiplying number of shares held by them with the market price of that share. So let us continue with my example. I have purchased 100 shares at rupees 10. So right now its value is 1000 rupees. But suppose after 2 years, the market price of these shares is 200 rupees. So 100 shares into 200. So it will become 20,000. So this increase is known as increase in wealth. And this is one type of capital profit. The financial management focuses on the three major financial decision areas, namely investment decision, financing decision, and dividend decision. We will discuss in detail all these three decisions. They are collectively known as finance function of business. So what is finance function of business? Finance function of business means investment decision, financing decision, and dividend decision. So in this portion, we have covered two main objectives of financial management. One objective is maximization of profit, and second objective is maximization of wealth. Now, finance function. That means we will discuss now financial decisions. In that first decision is investment decision. It is concerned with how firms' valuable funds are to be invested in various assets. It will include the following: investment in long-term assets, long-term investment decision, which is also known as capital budgeting decision. For example, purchasing a new machine, opening a new branch, all these are the long-term investment. Second, short-term investment decision, which is known as working capital decision. It is decision related to day-to-day working of a business. For example, what would be the level of cash in hand? What would be the stock in hand? All these decisions are short-term investment decision. And third portion, we will discuss different factors affecting these two decisions. After collection of fund from various sources, a business manager has to make investment of the fund. So the investment of fund in various short-term and long-term assets is known as investment decision. So this area is regarding investment of fund. And not only the investment, there should be the effective investment. We should make investment at such a place where maximum return is available. So now let us take the first portion, long-term investment decision. That means capital budgeting decision. And as we all know, capital budgeting decision is related with the investment of fund in long-term assets. Say for example, investment in land, building, plant, machinery, expansion of business, opening a new branch, and all this. So you can see here, the next portion is factors affecting capital budgeting decision. The first point, cash flow of the project. The inflow and outflow of cash in the business should be considered before making capital budgeting decision. Some project will take a long period of time to start inflow of cash. So while making investment decision, you should check that after how many years firm or business is going to earn cash, because many times plant requires long period, 2 3 years, 4 5 years, 5 to 10 years, and thereafter income starts. So inflow as well as outflow. Inflow means income from investment. Outflow means the amount which we are investing. So when you are taking decision regarding investment in long-term assets or long-term plans, then you should check the probable inflows, and you should also check after how many years business will start earning inflow. We should select such a project which has higher cash inflows and which gives early return, but that is not possible in all cases. Second point, the rate of return. When we make investment, we expect some return. So we should select such a project which gives higher rate of return. So while selecting a project, the rate of return must be considered. If two projects having 10% return and 15% return with almost equal risk, normally the second one may be selected because the second project has 15% of return. So investment should be made in such a project which gives higher return. The third point is investment criteria involved. That means while making decision, there are various investment criteria you have to consider. Like investment decision must be based on certain capital budgeting techniques. There are different capital budgeting techniques which help us in deciding where to make investment, in which project to make investment. So those capital budgeting techniques should be utilized. Techniques or calculations regarding the amount of investment. We should also consider what amount of investment we have to make. We should also consider rate of return. What interest rate we have to pay if the amount is borrowed, and what would be the probable cash flow? What will be the cash outflow? So there are so many investment criteria. They all should be considered. Such a project should be selected which gives higher return, higher cash inflow in short period of time. Riskier project cannot be selected if we are new. Risk should be considered while making investment. Second, financing decision. Financing decision is regarding collection of funds from various sources of finance. Our first decision was investment decision, but for making investment, we need fund. Now, we should decide from where fund is available. So it is concerned with the quantum of finance to be raised from various long-term sources. Based on investment decision, you can decide what amount of fund is required in your project. They are shareholders fund and borrowed fund, such as shares, debentures, loan, etc. So in financing decision is taken regarding different sources of finance from where fund is raised, because ultimately that fund would be invested in various projects. So for investment, we require fund. So in financing decision, we take decision regarding from where fund would be available. Now, before taking financing decision, that means before deciding different sources of finance, the given factors should be kept in mind. The first factor is cost of fund. So we should try to obtain the fund from cheaper sources, because shareholders, debenture holders, etc. expect some return. On debentures, we have to pay interest. That is the cost. On shareholders fund, we have to give dividend. That is the cost of equity. So, keeping in mind cost, proper source of fund should be selected. Risk. All sources of finance have some risk. So risk factor in each source must be considered. Say for example, if you collect fund by debentures, then compulsorily you have to pay interest. Even if your business is making loss, you have to pay interest to the debenture holder. So it is a risky. So this risk factor should be considered. But if you have collected money by way of equity shares, then it is not compulsory to pay dividend on equity shares. So equity shares are less risky compared to debentures. So this risk factor should be also considered. Flotation cost. When you select particular source of finance, you have to incur different types of expense. They are known as flotation costs. So it is nothing but it is a cost of raising finance. A manager should select such a source of finance which has less amount of flotation cost. Say for example, when you issue shares, then you have to print prospectus, you have to make advertisement. All these are the flotation costs. Okay, so this type of cost should be low. Next one is cash flow position. A stronger cash flow position recommends more debt financing. Meaning to say, if cash flow position of business is strong, we have enough amount of cash flow from our project, we can select debenture, we can select debt financing because we would be able to pay interest on this debt financing. Next one is fixed cost. Business has to pay different types of expenses. Now these expenses are maybe fixed. They are fixed operating costs. Say for example, rent. If you have taken any property on rent, then every month you have to pay rent. This is your fixed operating cost. Insurance premium, it is also fixed. Salaries to employees, it is also fixed. If all these operating costs are high, then it is better to reduce debt financing. That means we should not issue debenture, more amount of debenture, because if you issue debenture, then you have to pay fixed interest also. So your burden will again increase. So if your fixed cost, that means fixed operating costs are very high, you should select not debenture, but you should go for other sources of finance. Thereafter, control. Different sources of finance have different types of control on management. If you issue equity share, then they become the owners and they can change the management. But if you issue the debenture holders have no control over the management because they are the borrowed fund, they are the creditors. They do not have control over business. So if you prefer to keep control of the present management, present shareholder, then you should issue less number of equity share and more amount of debentures. More dependence on owners fund will reduce control because new equity shareholders will get power in management, will reduce control among the existing shareholders. So your preference for keeping control on management should be also kept in mind while deciding sources of finance. Next is capital market condition. That means the stock market condition. What is the position in stock market? During rising trend in capital market, it is easy to accumulate shareholders fund. If the market is going up, people are interested in making investment in shares. During that time, if you issue shares, then it would be easy for you to sell it because market is going up. But if the market is not going up, if there is a recession in the market, then no one would prefer to invest in equity shares. So during that time, you should not go for equity shares. So capital market conditions should be also kept in mind. Third, and the last decision, that is decision regarding distribution of profit and retention of profit in business, which is known as dividend decision. It is concerned with the disposal of profit. Whatever profit is earned, out of that, what amount of profit should be retained in the business and what amount of profit should be distributed to the shareholder as a dividend. That is known as dividend decision. Most of the business houses do not distribute entire amount of profit as dividend. What they do, they keep some amount of profit as a retained earning in the form of reserves so that that profit can be utilized in future for business expansion and various business purposes. So this decision is nothing but is the decision regarding what amount of profit should be distributed as a dividend and what amount of profit should be kept in business as a retained earning. A portion of the profit is to be retained in the business for growth and expansion. A part of profit is called retained earning. That part of profit which we have kept in business, which is not distributed, is retained earning. And the rest of the profit is to be distributed to the shareholders in the form of dividends. Here the role of financial management, that how much is to be retained and what would be distributed, that is dividend decision. So students, we covered three important decisions. First one was investment decision. Second one was financing decision. And third one was dividend decision. All these three decisions together known as financial decision or finance function. I think you must have understood this. Now, various factors affecting dividend decision. So if you are deciding to retain profit or to distribute profit as a dividend, then what are the different factors you should keep in mind? And that the first point is amount of earnings. That means amount of profit. Dividend decision is always depend on the amount of profit during the current period. If you have huge amount of profit, you can give dividend. But if your earning is less, if your profit is less, then you should think what amount of dividends should be distributed. Second, stability of earning. If your profit is stable, every year you are earning the good amount of profit, then you can give higher dividend because your profit is stable. But if you have unstable earning, sometime profit is very high, sometime profit is less, sometime loss, then in that case you can't give proper, that means stable dividend. So stability of earning is also important while deciding what amount of dividend should be distributed. Next is stability of dividend. See, only earning is not important. We have to also keep in mind our investors, our shareholders. If you do not pay them dividend for 2-3 years, they will lose confidence in your company and they will not, they will sell shares and they will not invest in your company. They will start negative marketing about your company. So to improve confidence of shareholder, you should pay the stable dividend. It will improve the confidence of the shareholder and higher reputation for the company. So while deciding dividend payment, you should also keep in mind stability of dividend. And for that, many companies create dividend equalization reserve so that in the year of less profit, stable dividend can be paid to shareholders. Next one is growth opportunities. Means what are the opportunities available in future for the expansion of your business? If you have strong probabilities for expansion of your business, what you can do? you can reduce your dividend, you can make more return earning so that that return earning can be utilized for the expansion of your business. So fewer dividend may be given to the investors if the company is having growth and expansion projects. Next one is cash flow position. If you want to pay dividend, you have to pay cash. So you should have enough amount of profit in the form of cash. Having profit doesn't mean you have that much amount of cash, because profit also includes credit sales. While we calculate profit, we also take sales, credit sales. So all amount of profit is not always in the form of cash. Company may be having 1 crore of profit, but its actual cash may be less because of presence of credit sales. So to pay dividend, we need cash. So you should check what amount of cash is available before before deciding dividend. So payment of dividend involves outflow of cash. Therefore, enough cash must be available for the declaration of dividend. Without availability of cash, you can't declare dividend. Otherwise, what will happen? To pay dividend, you have to borrow money, and that will again increase your cost. So that is not a good financing decision. Next is shareholders' preference. Normally, shareholders want to get regular income from their investment. Hence, at least a minimum dividend may be distributed every year. So if shareholders prefer dividend, then minimum dividend should be distributed. Taxation policy also you have to keep in mind. If tax on dividend is higher, it is better to pay less tax. It is better to pay less dividend by way of dividend. But the dividend are free of tax in the hand of shareholder, as a dividend distribution tax is levied on companies. In the present tax policy, shareholder may demand higher dividend. So what is the taxation policy? You should keep in mind what is the percentage of tax on dividend. If the tax on dividend is higher, it is better to pay less dividend. Next is stock market reactions. Investors generally evaluate the companies on the basis of their dividend declaration status. Higher the rate of dividend gives a positive impact in the market. So if you are planning for public issue in the coming years, then you should pay high dividend. So it will create positive marketing in the minds of the investor. People will think that this company is paying high dividend. So when you will go in the market, in a stock market, with new issue of your share, people will start investing in your company because they know this company is paying higher dividend. So stock market reactions should be also kept in mind. Access to capital market. Reputed companies generally have easy access to the capital market, and therefore they may depend less on retained earning to finance their growth. So they may declare high rate of dividend than small companies. So if you can easily collect money from stock market, then you can pay high dividend. Then in that case, there is no need of retained earning. But if it is difficult for you, you are a new company, you have no strong reputation, then in that case, what you can do? You can retain more earning and you can pay less dividend so that retained earning can be utilized for future purposes. Next point is legal constraint, contractual constraint that you can go through here. Legal constraint. While declaring dividend, the companies have to follow the restrictions laid down by Companies Act. Contractual constraints. While granting loan to companies, sometimes the lender may impose certain restrictions on the payment of dividend in future. So if you have borrowed money from bank may put restrictions on your dividend declaration. So if such contractual restrictions are then they should be considered while deciding the dividend.